Okay, today we're going to talk about non-current liabilities, more commonly called long-term debt. Okay, last time we talked about current liabilities, and we looked at a wide variety of current liabilities, accounts payable, notes payable. We talked about notes payable being current. It could also be non-current, and so you could have a note payable in the non-current section. We talked about that last time. That is sufficient. And then we have non-current liabilities like bonds payable, mortgages payable, leases, pensions, deferred taxes. Okay, and so we're going to focus most heavily on the bonds. Okay, bonds are when very large companies need to borrow money, and lots of it, typically in the hundreds of millions of dollars. Okay, and so rather than go to one bank and borrow a few $100 million where they're going to be charged a higher interest rate because there's a lot of risk involved with that kind of money for one bank, they're going to spread it out over investors. And so you're going to have many investors in, putting in a few $1,000s through mutual funds, through retirement plans, that type of thing. And it's going to allow them to raise a lot of money at a more favorable interest rate. Okay, and so we're going to take a look at a bond, and we need to talk about some definitions and bond terminology. First, bonds are either term bonds or serial bonds, and I'm going to turn around and we're looking at the board here. I know I'm probably cutting you off a little bit, but for example, let's say we have a $10 million bond. We call that the face value of the bond, the principal, and it pays an 8% interest rate, which we'll call the contract rate. Okay, if it's a serial bond, then what that means is each year, at the end of the year, we're going to pay back 1/5 of the bond principal, or $2 million, plus interest each year. And each year, the amount of interest we pay is going to decrease, kind of like that notes payable example we did earlier. Or if the bond is a term bond, then the entire $10 million will get paid back at the end of the 5th year, the end of the term, when the bond matures, the maturity date or due date. But we'll pay 8% interest on $10 million each year annually. Okay, so bonds can be structured differently. We're going to look at a term bond in our example. Okay, but there's term bonds and there's serial bonds. Additionally, a bond can either be secured or unsecured. A security or secured bond is collateralized. So for example, if we issue bonds and they're secured, perhaps the security is the trust deed to property, some land and buildings that we own. In the event we can't pay the bond back or the interest, the bondholders can then grab the real estate, sell it, and recover part of their money, or hopefully all of their money. An unsecured bond, which is called a debenture bond, I don't know the origins of that word debenture, but a debenture bond is an unsecured bond, no collateral. It's issued on just the general credit of a company, which we'll talk about a little bit later. Okay, so we have term bonds, serial bonds, secured, unsecured bonds. Now, bonds can be convertible, which means they would convert into shares of common stock of the company, and that's a nice feature for the bondholder in case the common stock is increasing in value. Okay, they can also be callable, which is good for the issuing company, the company borrowing the money. And if interest rates drop in the future, they have the right to call in those bonds saying, okay, we're going to pay you back early, and then we're going to refinance at a lower interest rate. Or perhaps they've been generating profits and they simply don't want to carry any more debt. So that's kind of into the advantage of the issuing company. Okay, and then we have a couple other terms that we need to be familiar with. We have the face value of the bond. In this case, our example is $10 million in total. Each individual bond, and I have an example of a bond I'm going to show you momentarily, each individual bond will have a face value of usually $1,000, could be $5,000, $10,000. It'll have a contract rate, which is the rate of interest we're going to pay on the principal, and then we have to factor in the market rate, which is more commonly called the yield, or sometimes called the effective rate. Okay, let's talk more about that. Here's a bond certificate. Okay, this is the face of the bond. And as we can see in this particular example, each bond certificate has a face value of $5,000. The contract rate on this bond is 11.875%. The maturity date is 2008. I don't know when this thing was issued. Somewhere on there. It looks like 2005 in very small print. And so this contains a lot of information. Now, I do need to say that issuing bonds is a complex and expensive process. Issuing bonds to the investing public is overseen by the Securities and Exchange Commission, the SEC, just like stocks are. And so you have to file a lot of reports with the SEC. You have to produce what's called a prospectus, which allows potential investors to do research on this bond issuance to see whether or not they want to invest in your bonds and assume whatever risk is involved. You have what's called the contract, or what's called the bond indenture. A lot of new words here. The bond indenture is the contract, legally binding contract between the issuing company and the bondholders, who are the investors. And then you have the certificate. So there's a lot of stuff that takes place. You've got a lot of lawyers who are very expensive. You got the CPAs, the accountants. You got the investment bankers, and so a lot of people involved in this. Not to mention the SEC as well. Okay, so the face value or par value, $5,000 per bond, but we'll talk about the total face value. In this case, in our example, it was $10 million. Okay, the contract rate is stated on the bond, and that's the amount of interest we pay on the face value. So in this bond, 10 million times 8%, I would pay $800,000 interest at the end of each year. In our example, we're simply going to do an annual, one time per year interest calculation, but bonds more commonly pay interest twice a year or semi-annually. But we're going to keep it simple in our example. Okay, now, we said that we have a contract rate, but we also have a market rate or yield, and interest rates in general are in constant motion. And they're not really controlled by any one person or party. The institution that most affects interest rates is the Federal Reserve Bank. Okay, they set interest rates, but interest rates move on their own in response to economic factors such as inflation, unemployment, stock market volatility. When the stock market's going up and down and up and down, sometimes people get out of the stock market and they invest in bonds. A lot of foreign investors invest in U.S. bonds because they're safer than overseas. Other economic conditions, the price of oil, price of real estate, the price of gold, political instability in the Middle East, for example, or other regions could all affect interest rates. And so interest rates are in constant motion, okay? The other factor that affects a particular company's interest rate is what we call their credit risk rating. And companies, the most popular ones are Moody's and Standard & Poor's, will evaluate the financial strength of a company, and they'll assign a credit risk rating. Generally speaking, AAA is the strongest rating, okay, then AA, single A, triple B. Once you get down to single B, triple C, you're starting to head into the what we call junk bond category, where these are high-risk bonds. And below, once you get into the C's, you're actually in default. And these bonds have just become bad news. Okay? So companies want preferably some sort of an A rating, and again, the higher the better. The higher the credit rating, the lower the interest rate we have to pay, the less interest we have to pay, which is obviously desirable. It's like if you buy a house, you want to borrow at a lower interest rate. Same thing for a business. Okay, so the market rate, and we need to know the market rate because that helps us to determine the value of these bonds on the day we issue the bonds, are affected by economic factors, the interest rate set by the Federal Reserve Bank, and of course by your company's credit rating by one of these companies. Okay, now, here's the general concept that you have to try to understand for bonds. It's rare that the market rate will be the same as the contract rate because we have to lock in the contract rate early on in the process because we have to print a lot of documents that say, okay, the bond's face value is $10 million. We're going to pay you 8%, 7%, whatever it may be. Okay? We got to have a lot of third parties, the attorneys, the accountants, the investment bankers, the SEC, review all this information, and everything has to be communicated to all the parties. It doesn't happen quickly. So we lock in an interest rate, and it may be several weeks to several months before we actually release the bonds on the market and raise the money. And at that point in time, the interest rates will have gone on up a little bit. Maybe they've gone down a little bit. If the contract rate and the yield are the same, which again is rare, then we issue the bonds at face value, which means in our example, if the face value is 10 million, we're going to receive 10 million in cash. And the journal entry would be very simple. Debit cash for 10 million, credit bonds payable for 10 million. If the two rates are the same, and then the amount of interest we pay, in this case, 800,000, that's the amount of interest expense that we're going to report on the income statement. I would debit interest expense, and I would credit cash, 800,000. Very simple scenario. More often than not, though, the two rates are not the same. And that's where these next two descriptions come in. If the contract rate is less than the yield, then we are paying slightly less than the market requires for our particular bonds because rates have drifted up a little bit. And so what this is saying is we're paying 8%, but everyone else who has bonds of a similar credit rating are now paying, say, 8.33% or 8.25% or 9%, whatever it may be. Typically, it's not going to move up that much, but it'll inch up a few fractions of a percentage. If that's the case, then since the market requires a higher return than our contract rate, we're going to have to reduce the price of the bonds just a little bit, and we call that a discount. Okay? So the bonds we'll issue will be less than the face value. We're going to receive a little bit less than the 10 million, and we're going to issue the bonds at a discount, and as a result, this is going to have an effect on the amount of interest expense that we report on the income statement. Because remember, interest expense is an accrual accounting concept. And so we're going to have to adjust the interest expense, and we'll see how we do that momentarily. But our interest payment is actually going to be a little bit less than the amount of interest expense that we report on the income statement each year. So the shortcut that we're going to take is if we issue bonds at a discount, which is an amount less than the face value, then I'm going to say we're going to issue the bonds at, say, 96, which means 96% of face value. So I would simply multiply 10 million times 0.96, and that would give me $960,000. Okay? Face value is 10 million. We're going to receive, I'm sorry, 9,600,000. I think I said the number wrong. And we would have a discount, which is the difference between the face value and the amount of the proceeds, the cash we receive. We're going to do an example, and I'm going to show you the numbers. The difference between those two numbers is the discount, and we're going to have to amortize the discount. Amortization of a bond discount is identical to depreciating an asset. We're going to spread out that number over the life of the bond, just like we depreciate an asset over the life of the asset. If, on the other hand, interest rates have dropped a little bit, then the contract rate will be slightly higher than the yield, and as a result, we're paying them a little bit more than the market requires us to pay. And just like you wouldn't want to have to pay an interest rate higher than necessary, nor would companies. So rather than have to reprint all those legal documents and have everybody spend all this time proofreading and getting approval from the SEC, way too much work, we're simply going to adjust the price just like we did for discounts. However, we're going to charge them a little bit more because we're paying a slightly higher interest rate, and we call that a premium. Okay? As a result, we're going to receive slightly more than the face value. The difference between what we receive and the face value we're going to call the bond premium, and that's also going to be amortized or spread out over the life of the bond. So, for example, if we issue the bonds at 103, that means we're issuing them at 103% of the face value. I would multiply 10 million times 1.03, and that would give me 10,300,000, and I'd have a $300,000 premium. Okay? So if you issue at 104, it's 104%. If you issue at 97, it's 97%. If it's less than 100, it's a discount. If it's more than 100 that we're issuing at, it's a premium. Okay? And then notice the interest payment of $800,000 in this example is going to be a little bit more than the interest expense that we report on the income statement. And again, we're going to see how to do that next. So let's go ahead and take a look at an example. In our example, on January 1st, 2010, we issued term bonds with the following data. Face value is $1 million. I'm going to change the board just to reflect this. Okay, so we have $1 million bonds, and these are term bonds, and our contract rate is 7%. Is 7%, so the interest payment is 1 million times 0.07, and that is what? $70,000. So each year, I'm going to pay my bondholders $70,000. Okay? So each year I pay $70,000. And I'm sorry, my bonds go out 10 years. So 6, 7, 8, 9, 10. So every year I'm going to cut a check for $70,000. And then at the end of the 10th year, I'm going to pay back the $1 million at the end of the term. Okay? Notice, my market rate or yield is 8%, which is a little bit higher than my contract rate. As a result, I'm going to have to charge less than the face value. I'm going to have to discount the bonds. Since the yield is greater than the contract rate, we will issue the bonds at less than face value, which is a discount. In our example, we're going to assume the bonds were issued at 95 or 95% of face value. So I multiply $1 million, 1 million times 0.95, and that's going to equal $950,000. And here's my journal entry to record the bonds on the day we issue the bonds. I'm going to debit cash for $950. I'm going to credit bonds payable for face value. We always credit the bonds payable at face value because at the end of the 10th year, I got to pay back $1 million. And I'm going to debit the bond discount for $50,000. And I'm just going to put the T accounts up here. Here's bonds payable. I'm going to abbreviate bonds payable, 1 million. And here is my bond discount. And notice that a discount has a debit balance. This is a contra liability. Liabilities have a normal credit balance. This has a debit balance. And we're going to amortize this bond over the 10-year life of the bond, just like depreciation, and we're going to use straight line amortization. So if we take $50,000 and we divide it by 10 years, each year I'm going to amortize the bond $5,000. And we're going to figure out what this means in just a little bit. Okay, now, if in a separate example we had issued the bonds at 102 or 103, that would be a premium. I would receive more. Here's my debit to cash, credit to notes for $950. I'd be debiting cash for an amount more than $1 million. My premium, my bond premium, would have a credit balance. The discount has a debit balance. The premium would have a credit balance. And that would affect how we amortize these two. Since I have a debit balance, every time I amortize the bond, I'm going to credit the bond discount. If it was a premium, which has a normal credit balance, I'd be debiting the bond premium for the amount of the amortization. So this is a good time to ask, well, what exactly is this bond discount? It's kind of this weird idea. And look what's happening. Because the market rates drifted up between the time we locked in that 7% and the time we actually released the bonds on the market, interest rates went up. Now, they typically wouldn't go up a full percentage point, but for simplicity's sake, we'll assume they inched up 1%. It'd be more like maybe the market would be 7.13 or something along those lines. But for simplicity, we're going to go up in whole percentage points. As a result, we had to issue the bonds at a discount, some amount less than 100% of face value, and I just arbitrarily chose 95. We could actually calculate to the penny the exact amount, but it's a little bit more complicated, and we don't need to do that here. We issued the bonds at $950,000. At the end of 10 years, I am contractually obligated to pay them back $1 million, and I'm contractually obligated to pay them 7% of $1 million at the end of each year. So each year, I'm going to cut a check for $70,000. At the end of the period, 10 years, I'm going to pay them back $1 million. So they gave me $950. I'm going to give them back $1 million, and of course interest. And here's what this looks like in a chart. They give me $950,000. I got to pay them back $1 million 10 years from now. So I got to give them back $50,000 more than they gave me because of the difference in the two interest rates. This is normal. So rather than call that additional $50,000 that I have to pay back, rather than call that an expense in year 1 or $50,000 expense in year 10, I'm going to spread that $50,000 out over the life of the bond, and that's what amortization is. So each year, I'm going to reduce the bond discount by crediting the bond $5,000, and each year I reduce the balance in the discount account. Now this is really called the unamortized bond discount, and on the balance sheet, I'm running out of board space here. Let me see where I want to put this. I'm going to erase this here. On the balance sheet, I report the bonds at book value. Book value equals the face value less the unamortized portion of the bond discount. So in our example, at the end of year 1, the book value that I put on the balance sheet December 31st would be $1 million minus $45,000 would be $955,000. That's the book value. End of year 2, I amortize another $5,000, and the unamortized discount's $40,000. My book value on the balance sheet would be $1 million less $40,000 or $960. So notice that the book value, and that's the dotted line there, slowly increases as the bond discount gets smaller. The book value is going to get larger until the discount at the end of 10 years will be 0. It'll be gone. And the book value will be $1 million because that's the amount I am required to pay the bondholders collectively, $1 million. So what I'm doing is this. That additional $50,000, the difference between $1 million and $950,000, I'm going to spread, that's an additional cost I have to incur because interest rates had moved higher. As a result, I'm spreading out that $50,000 over 10 years, and each year I'm going to increase my interest expense by $5,000. And here's what the journal entry looks like. On December 31st of each year, notice I'm going to cut a check, I'm going to credit cash for $70,000, and I'm going to credit the bond discount, the amortization of the bond discount, $5,000, that's this right here, and I'm going to debit interest expense for $75,000. So notice my interest expense, which goes on the income statement each year, is slightly higher than the amount of cash I'm actually paying the bondholders because of the amortization of the discount, because I'm spreading out that additional cost and adding it to my interest expense. I'm not cutting a check for an additional $5,000. They gave me $950 on day 1. I'm giving them back $1 million at the end of the 10th year. I'm spreading out that $50,000 in increments of $5,000 every year for 10 years. Okay? And as a result, my interest expense is greater than the amount of cash I'm paying them each year for interest. At the end of the 10th year, I call in the bonds, or the bonds get redeemed. I'm paying them back what I owe them. Remember, it's a loan after all. So I'm going to debit the bonds payable for $1 million. That's going to zero out the bond account, and I cut a check for $1 million. I credit cash for $1 million. This account will be down to 0 within 10 years, by the end of 10 years. And when I pay the bond back, that's also gone, 0. Had this been a premium, Remember the premium, I'm going to create a premium account here, and I'm just making up a number, just to give you an example. Say, for example, the premium had been for $50,000, so we issued the bonds at 105%. I would have debited cash for $1,050,000, credit bonds payable for $1 million, and credit the bond premium for $50,000. Each year, I would debit the premium for $5,000, and the journal entry would be this. And I'm not going to put it on the board, just visualize it. I'm still going to credit cash for $70,000, but I'm going to debit the premium for $5,000, and I'm going to debit interest expense for $65,000. 65 debit plus 5 debit is 70, and we have a credit to cash for 70. Okay? And so because they're giving me $50,000 more than I have to pay back, if we go back to the previous slide, okay, I don't have it up here, but if you just take a look at the $1 million straight line there, above that is $1,050,000. It's going to slope down in the same direction that the 950 slopes up. We're going to amortize that bond, okay? And they're giving me $50,000 more than I have to pay them back. Why? Because interest rates decreased after I locked in my 7%. And because I'm paying them a higher rate than the market requires, I'm going to charge them a little bit more. And I'm going to spread out that premium over 10 years, and it's going to reduce my interest expense by $5,000 a year. So even though I'm paying them $70,000 in interest each year, my interest expense in a premium would be $65,000 per year. Okay, so it works in the opposite direction of a bond discount. Okay. I had skipped over a slide, but I think I pretty much described it. We talk about what the discount is, and I've kind of described all this in some way or form. I'll let you read this on your own, and hopefully it makes sense. But notice towards the bottom, the reason we amortize the discount or premium is because the matching concept or the matching principle, which is one of the two basic rules of accrual accounting, revenue recognition and the matching concept. Matching concept says spread it out over the life of the bond, match the expense to the revenue it helps to generate. And what we assume is that the discount or premium relates to the cost of borrowing for the bond. And so we adjust interest expense by the amount of the premium or the discount. And as we saw in the journal entries, it affects the amount we record as interest expense on the income statement. It's an amount that's different than the actual check we cut for interest. Okay? Hopefully that made a little bit of sense to you. The last thing we want to talk about today are the ratios related to long-term debt, which we call solvency ratios. The first one is the debt to assets ratio, and then we have the times interest earned ratio. So let me just describe these. You can plug the numbers in. Okay? Debt to assets ratio says total liabilities divided by total assets. And that's telling us what percentage of the assets are being financed by borrowing. How much do we have to borrow to acquire those assets? And so with the debt to assets ratio, the higher that ratio is means we are carrying more and more debt. We've borrowed more money to acquire assets than if we had a lower debt to assets ratio. If I'm a bank or if I'm a creditor, okay, I'm very interested in a company's debt to assets ratio because before I loan them more money, I want to see how much have they already borrowed. Are they in a position to take on more debt? And can they pay me back? If they have all this other debt, is it going to be a risky loan? So I look to the debt to assets ratio to see if this borrower is in a position where they can handle a greater amount of debt. Okay, creditors, people who we owe money to, are interested in our debt to assets ratio. And the higher the ratio, the higher the risk, because we're carrying a lot more debt than if the ratio is lower. The second ratio, the times interest earned ratio, is EBIT, which stands for earnings before interest expense and tax expense. earnings before we subtract interest expense and before we subtract tax expense, divided by my interest expense. Now, EBIT most commonly is your operating income. Let's visualize, I'm not going to put it on the board, my multi-step income statement. Sales revenue, or sales, minus cost of goods sold equals the gross profit. Gross profit minus operating expenses, like selling and administrative expenses, equals operating income. That's typically my EBIT right there. Operating income minus interest expense equals taxable income, or earnings before tax expense, and then taxable income, or EBT, minus my tax expense gives me net income. Okay, so operating income, or earnings before interest and taxes, divided by my interest expense tells me, or tells the person looking at this ratio, how much earnings do they have to cover interest expense each year. And this number, this ratio, the bigger the number, the more easily the company can handle making those interest payments. So we want to see a larger number, because that means they've got a lot of profit, they can easily cover their interest expense. As the times interest earned ratio gets smaller, as it approaches 1 to 1, then interest expense is consuming a greater percentage of the company's profits. And as a banker or a creditor, I don't want that ratio to get too small, because I get nervous, I'm getting concerned that they're not going to be able to pay me interest, let alone pay back the loan. Okay? So we want that number to be larger. These are both solvency ratios that relate to long-term borrowing, and your creditors take a good hard look at these. And in fact, when you issue bonds or you borrow money on a note payable, they may actually require you to maintain these ratios at certain numbers. They call these covenants, loan covenants. Where a covenant is a contractual obligation that you have to meet these numbers, or else they're going to say you're in violation of the agreements of the loan, you got to pay us back now. They'll call in the loan. And that could be bad news for a company. Okay, so in closing, both ratios are looked at by creditors to evaluate the company's ability to repay outstanding debt and the related interest, and these are commonly used ratios, so you should know them. Okay, and that concludes our discussion for today.